Hi everyone, it's great to see you. My name is Matthew Griffin. I'm the CEO and founder of the 311 Institute, a global futures and deep futures think tank looking up to 50 years out. I cross every technology, every trend, every sector, every line of business and every region. And in this particular presentation that was first given to the Moroccan Central Bank in Marrakesh a couple of months ago, we're going to be talking about the future of African banking. We're going to be having a look at money and payments as well. We're going to be going up to 20 years out in this particular case. However, a lot of the things that I'm going to be showing you actually apply to the tier 1, tier 2 and tier 3 banks anywhere in the world. Now, when we have a look at access to mobile financial services, over the past 10 years, we've seen over 1 billion people being included into the financial services community simply because they have banking on a smartphone. So we always have to be thinking about the so what. It's all very well to have a look at what new technologies and new ways of thinking can do basically for society, but fundamentally, you've got to be pulling it back to the need, the so what. Why should we care? So let's start going through some statistics. Now, when we have a look at people in Uganda and we compare people who have access to financial services and people who don't, then people who have access, typically 43% of those people have emergency savings. For people who don't have access to mobile financial services, only 28% of them actually have emergency funds available to them. So that's quite a decent difference right there. Now, when we have a look at things basically from a small business perspective, small businesses with access to mobile financial services, 30% are 30% more likely to take out a loan. Now, those loans can be used to invest in the business, invest in inventory and growth. However, in addition to that, 60% of SMEs, and this is in Ghana, Kenya, Nigeria, and South Africa, these surveys basically have been done recently. 60% of SMEs who have access to mobile financial services actually report being able to get access to more customers. So these are all good things. Now, when we start having a look at gender equality, 50% of women who have access to mobile financial services are much more likely to start a business. Uh, we saw 80% of businesses saying that their businesses were growing because they had access to financial services. But then in addition to that, the fact that we now can do transactions on smartphones, which we in the West take for granted day in, day out, we've seen a 90% drop in overall transaction costs. Now, depending on the country that you're actually in Africa, cross-border payments can suck up to between 10 to 15% of your overall payments. So a 90% drop makes banking on the one hand more affordable, but this also represents the reduction in friction basically between different payment systems, different countries, and so on and so forth. However, when we have a look at the digitization of the banking experience, of course, fraud comes with it. So 63% of people in South Africa have experienced fraud and cyber attacks. 70% of people in South Africa have been targeted by fraud, by financial-based scams. However, in Nigeria, businesses that have been using mobile banking services, as well as the banks themselves, in the past 3 months alone, have seen a 276% increase in the number of scams. So that is off the charts. And being honest, I'm worried about these numbers because as we digitize throughout Africa, unless we are doing proper consumer education, these scams, these frauds are only going to increase, but they're also only going to become more and more successful, especially as we see the rise of generative artificial intelligence being used in things like phishing scams, for example. So when we have a look at the bank of the future itself, though, every single bank that I talk to says this: we put our customers first. They don't. So let me unwrap that. Every bank thinks they put customers first. However, When was the last time that your bank made you rich, or even richer? Now, I bank with HSBC and a couple of other banks. Now, for example, in my particular case, HSBC provides me with 0% interest on all of my savings with them. So as we see record rates of inflation, high cost of living, and so on and so forth, as we see wage suppression and depression, depending on the countries that we're actually in, the money that most of us actually have with our banks is decreasing in real world value. Year on year, our purchasing power is going down. So does that sound like a company or an industry that is actually putting their customers first? Because in this particular model, we are saying, come and bank with us and we will make you poorer. That makes absolutely no sense. So every time I speak to a bank anywhere on the planet, I challenge them on their business model. And when we have a look at that business model, it's a 4,000-year-old business model. It goes back to Mesopotamia, where people used to store grain and trade grain, and then they'd loan grain out. We saw the Medicis starting to use this model as well. People would give the Medicis their hard-earned cash. The Medicis would put it in a safe. That was really the first purpose of the bank, keeping your money safe from robbers and highwaymen in the UK and all these kinds of people. Now, the Medicis thought, well, if we do have all of this money in a safe, then why don't we loan it out and then we'll charge interest on the loans? And that actually became today's standard business model. So banks will take your money in, they will loan your money out. The business model has not changed in hundreds of years, and in some cases, thousands of years. And yet banks are constantly telling us how they are modernizing everything. I mean, if you look at JP Morgan, for example, they're spending over $12 billion a year modernizing the bank. But how are they really modernizing the business model? Now, again, when we have a look at the future of financial services, we can paint a picture of all kinds of different exciting things, and I'll show you some of those in a little bit. But fundamentally, a lot of it comes back down to the future of banking and financial services is whatever the regulators say it is, and also it isn't. So as we start having conversations with regulators about the art of the possible, suddenly banks might find themselves in a very, very different world. So with a lot of the banks that I actually work with, again, we kind of sort of start asking the question, are future banks super app tech companies? Now, when you go and have a conversation with any particular bank and you ask them what they do, they say, well, we take money in, we loan money out in terms of, loans, investments, whatever it happens to be, mortgages and so on and so forth. That's our business. If you go and have a conversation with a car company, they say, well, we sell cars. If you have a conversation with a retail organization, basically they say, well, we sell products. If you go and have a conversation with a tech company, though, and you say, well, what kind of business are you in? They just look at you, laugh, and say, well, we're in every business. Now, this is sort of where ultimately, as banks start digitizing more and more, they have the opportunity to become super apps. And we've actually seen a variety of different organizations, including JP Morgan, including Inter in Latin America, as well as Revolut in the UK, that are increasingly referring to themselves as super app companies. And that's before we go towards the neobanks. Now, let me give you an example. If we have a look at Revolut, then Revolut is a UK fintech. They now have a market capitalization of about $54 billion. However, they have always said from the get-go that they are a super app, despite the fact that investors will look at them as a fintech and as a traditional bank. Because once you have digitized your entire organization, it's very, very easy to add on extra services. So if we take Interbank, for example, in Latin America, Interbank was quite literally a bank. They then digitized, they dropped the bank from their name, and so they're now called Inter. but they now offer food delivery and so on and so forth. So are you a traditional bank, or are you actually a technology company that is providing financial services? Because if you're a technology company that provides financial services, then increasingly you should be able to move into new and adjacent markets easier than ever before. So when we have a look at Revolut, yeah, Revolut basically has really just got started. They're offering pet insurance and all kinds of different things. When we have a look at Inter, yes, they've moved into food delivery, but again, they're now moving into everything from telecommunications to smart home services and all kinds of different things. So these are two examples of organizations that could just toe the status quo line. However, they are now expanding out of their core business, and they're now moving into new markets, new areas, new growth opportunities. And when we have a look at some of the banks that we see coming up in Silicon Valley, they're unrecognizable. So for example, we have banks now that are social banks built on Web3, decentralized finance rails, basically, whose interfaces are augmented reality or even virtual reality. Then we also have surprising competitors. So when we have a look at the decentralized finance organizations out there, increasingly there is absolutely no reason why companies like Fortnite, for example, couldn't actually become a future competitor. Now, we could say a future bank or a future financial services company or a future fintech. Now, when we have a look at Fortnite, for example, Fortnite has 300 million active users. Most of the users that they have on the platform, banks are gagging for those users for the simple fact that the bank that you join when you are young is typically your bank for life. So now imagine Fortnite, who actually make about 90% of their profits basically through micropayments for digital assets. So that's Fortnite skins and all these kinds of different things. Now imagine if Fortnite said, we've got an e-money license. We are going to enable payments on our platforms. There's a Fortnite debit and credit card coming. We're going to turn ourselves into a bank, whatever it happens to be. All of a sudden, when we have a look at what technology allows us to do without having to go to DeFi, all of a sudden, we have the ability to use technology in different ways, combined with a strong leadership vision to disrupt and enter markets that originally would have been very, very difficult to move into. We also have this. This is a smart fridge. However, it could also disrupt any global bank. So I showed this off to HSBC in Hong Kong not so long ago. And this is how this works. So the smart fridge is connected to the blockchain. When you run out of milk, it says, you've run out of milk. I will buy you new milk because I'm a smart fridge. Now, if you normally pay $1 for your milk, these smart fridges can all start forming an e-consortium, so a big buying consortium. If 1 million people have run out of milk, these fridge consortiums can now go to organizations like Sainsbury's, Carrefour, etc., Walmart, and say, we want to buy 1 million pints of milk. We normally pay $1 per pint. Whoever gives us the best deal gets the deal. Now, imagine this. So Walmart says, well, okay, tell you what, in order to fulfill the request, we will sell you milk now for 80 cents. So the fridge has now saved you 20 cents and you get your milk delivered as you normally would in your groceries. However, your fridge now says, what would you like me to do with the 20 cents? Would you like me just to leave that in your bank account? Or would you like me to invest it? Bearing in mind that with some of the latest artificial intelligences, we're seeing the rise of robo-advisors. And in some cases, for example, in the United States, we've seen some robo-advisors making 64% returns on investments. So you choose to take that 20 cents and get the robo-advisor to invest it in a high-risk fund, for example. Years down the line, that 80 cents is now significantly larger. But it's not just 20 cents, sorry. It's not just 20 cents on your milk that you've saved. You could save 20 to 30% on your groceries. We calculate that using this particular business model, in the UK alone, a smart fridge could disintermediate your local bank and end up with about $360 billion in cash by the end of the year. So the combination of Web3 technologies and artificial intelligence, in this case, gives us a prime example of how something as random as a fridge or a kettle or a washing machine or a dishwasher or any connected device could disrupt your bank and global banking. Now, when we have a look at the problems that fintechs have, the vast majority of fintechs will build the products that they want to build. They will be neobanks, they'll be digital native and all that kind of stuff. But getting a regulator's license, for example, with the UK FCA, typically costs about £1 million. And it's a huge book that you have to give to the FCA. With organizations like Railsbank, which is a Web3 blockchain-based rail, you can simply tap into global banking with 5 lines of code. So when we have a look at organizations like Railsbank that are providing financial rails, new kinds of financial rails basically to the planet, all of a sudden we can see more fintechs emerging. The cost of them getting access to global banking falls dramatically, which means we see an increase in the amount of competition, and we also see them grow faster than they otherwise would. Fast forwarding, we see Bank 5.0. Now, Bank 5.0 is kind of no particular surprise. It's built on cloud computing, it's built on open standards, it's modular computing, it's API connections, and so on and so forth. Using artificial intelligence, the service that Bank 5.0 actually provides you is highly personalized. We start using time series artificial intelligence to predict what you are going to do next, what you're going to want to buy next, and so on and so forth. It can be fi digital. We've seen this with organizations in Australia, for example, where we're starting to merge augmented reality basically with credit cards. But it can also be semi-autonomous. So the vast majority of banks today are really automated. They are digital by design. They use robotic process automation, and so they're automated. But as we start moving to Bank 5.0, where we see increasingly sophisticated, smart, intelligent, capable artificial intelligence that has its own agency and autonomy to do things, we start seeing banks becoming semi-autonomous. As we have a look at Bank 6.0, a little while ago I was in Saudi Arabia, and I'm going to be back there again in a couple of months' time. In Saudi Arabia, with a social development bank, we used artificial intelligence, and it was a standard foundation model, not agentic artificial intelligence. And in 20 minutes, we built a bank from scratch, and then we did a soft launch. So as we start fast forwarding to artificial intelligence's own future, where we see the rise of agentic artificial intelligence, increasingly this is where we can simply give an instruction to an artificial intelligence to build a bank. It will create the business model. It will create the marketing plan. It will publish everything. It will complete the regulatory paperwork and so on and so forth. It could even start doing its own crowdfunding, which I'll come to in a moment. So increasingly, we think Bank 6 will actually be agentic banks. Now, agentic banks are quite different to Bank 5 because whereas Bank 5 has a traditional banking core, agentic banks could actually end up aggregating lots of decentralized finance services together under a sort of distributed autonomous organization structure and model. So this kind of bank, Bank 6.0, which we're starting to be able to create this now, but really it's going to get easier to do by the end of the decade. Agentic banks could be a fundamentally different kind of banking platform, and business, provided regulators allow it. And in some cases, we're seeing the technology racing away so fast that people are building these things and the regulators have no idea these things even exist, let alone how to monitor them, let alone how to regulate them. Now, as we start getting to Bank 6.0, increasingly, basically, these banks basically are going to be based on quantum cores, and they're going to have what we call OpenAI rails. Now, if you imagine OpenAI as a company today, so OpenAI is the company that's behind ChatGPT and these other kinds of platforms. If we get to the point where we can simply ask an artificial intelligence to build a bank for us, bearing in mind that at Harvard we asked artificial intelligence to build 70 businesses for us and it did by itself, autonomously. If we are using agents to build our bank, and those agents are from OpenAI or Microsoft or whatever it happens to be, then does this mean that OpenAI as a company starts becoming the banking conduit, the banking rails, and ultimately the banking core? So this is where we start seeing the potential disruption to traditional enterprise banking applications and systems that we have today. Now, of course, as we start using artificial intelligence more, basically within bank operations, it would make a lot of sense to have fully autonomous compliance. Now, when we have a look at the burden of compliance on most banks today, most banks I talk to say that they spend about 10% of their revenues on being compliant. So we have huge teams. Those teams are only getting bigger as we see more and more regulations coming through for a whole variety of different reasons. So when we have a look at things like Governance 2.0 or GRC 2.0, this is simply where we see a way to use artificial intelligence to do inward auditing, so internal and external auditing, transaction management, automated settlements, for example, and simply stick all of that information onto the blockchain. And if we have regulators that are also plugged into the blockchain, then via smart contracts, we can simply have automated compliance. Now, we're seeing the very early stages of autonomous regulators emerging in the UK with the FCA, who are starting to use machine learning to offer more automated, you know, verging on autonomous compliance to fintechs, but then also in Japan. And we've also seen autonomous compliance starting to come through in the US, although it's with the FDA, so the Food and Drug Administration, for the real-time approval of new artificially intelligence created drugs. So when we have a look at the future of bank compliance and regulations and GRC, we're doing some interesting things, but we've only just started. And when we have a look at the UI, I typically argue that we kind of have three sorts of banks, shall we say, today. We've got traditional banks, Bank 4.0, 5.0, whatever you want to call them. We've got fintechs, basically neobanks, and fintechs I just think of as being regular banks just with a digital core and a fancy front end. I mean, let's face it, we're still talking the same fundamental business model for most fintechs and most banks. Then we have decentralized financial services organizations, which I think are sort of more aggregators. But ultimately, when you have a look at the user interface on your smartphone for your bank, they all look the same. When we have a look at PFM systems, yes, you might bank with a bank that says you spent $30 basically this week on McDonald's or $300 on furniture or whatever it happens to be, and that you've got X, Y, and Z bills coming out and you're either going to have enough money or you're not going to have enough money. But fundamentally, the bank interfaces haven't really changed too much in the past 10 years. However, why can't we have banking interfaces that are conversational? Where you talk to your bank, you just simply ask it questions, whatever questions you want. Generative. Now, when we talk about generative user interfaces, this is where, for example, generative artificial intelligence today is able to rewrite its own code, create generative applications as they're known, and so on and so forth. So why couldn't generative artificial intelligence on the fly redesign your personal user interface so that my interface is different to yours and so on and so forth, depending on your own circumstances, experiences, skill levels, requirements, and so on and so forth. So generative user interfaces are dynamic and adaptable interfaces that we're starting to see the very, very early signs of with, for example, organizations like Microsoft. But this single thing lets us get away from these static PFM interfaces that we all know and hate. And then, of course, virtual humans. If we can talk to an artificial intelligence, basically, then why don't we just talk to an artificial intelligence with a face? So when we have a look at digital humans, increasingly we have digital humans with neural network brains where it's almost like talking to a real person. So I still think there's a huge amount that we can do to fundamentally reinvent the banking UI. And here's a little example from TikTok. As you can see, it doesn't look like a traditional smart banking app. I think it looks rather cool. But I haven't seen any bank even thinking about this kind of interface as a concept. And yet just think of the advantages. Now, when we have a look at money and payments, again, things are getting increasingly kind of science fiction like. Now, when we have a look at Web3, for example, when we talk about the future of money, money is simply the form of value transaction. The reason basically why the US dollar has value is because it's pegged to gold. Basically, in the US Fed says this piece of polymer, this piece of plastic has a value of $50 because we kind of say so. However, as we have a look at Web3, increasingly you can buy products with data. You can earn money with data, by sharing your data. If we have a look at Nike, Nike RKFT actually lets you buy virtual merchandise basically with moves. And if you have a look at IKEA in Dubai lets you start buy merchandise with time. So when we actually have a look at the future of money, we're not really talking about the future of fiat money. We're talking about the future of value and value transactions. And in today's world, that can quite literally be anything. It's always been anything. It used to be seashells, it used to be pebbles, it used to be deer hide. Now it just happens to be cryptocurrencies, maybe, if we have a look at things like stable coins and so on and so forth, or fiat currency. Or as we move into the future, central bank digital currencies, which some people love, some people hate. But a CBDC, for example, lets you manipulate an entire sovereign economy at speed and scale and apply real-time policies. So when we have a look at the future of money, provided we can get enough critical mass, provided we can get enough momentum, there's absolutely no reason why we couldn't all be buying our food with moves or furniture with time, etc. Now, we've also seen artificial intelligence recently create its own money. Now, in the United States, there was a man called Mr. Mankind. He was an artist, essentially. When artificial intelligence started creating its own art, he suddenly found that no one was visiting his website any longer. So he went to ChatGPT and he asked ChatGPT if the AI could help him create a meme coin. Now, ChatGPT created the business plan, it created the marketing plan, helped him come up with the name, which is TurboToad, and then it helped him write the code. Now, 2 weeks later, after posting to X and so on and so forth, TurboToad went to a market capitalization of $250 million on the Binance DEX in America. And even today, basically, it still has a market cap of around $50 million. So artificial intelligence quite literally made money that you could have taken to the bank out of nothing. Because remember, money is the perception of value. So a little bit earlier, I talked to you about decentralized finance organizations and how a decentralized finance organization, or even just a standard fintech, artificial intelligence, could go to the markets and do some crowdfunding. Now, if I wanted to start a bank and I actually needed liquidity in my bank, I needed capital for my bank, why couldn't I use something like this? Why couldn't I use an artificial intelligence to create a new cryptocurrency, send the cryptocurrency to the moon, as we recently saw with the Gotius Maximus crypto coin, which went from $0 in dollars in value to $657 million in value in 2 weeks because it got pumped up by an artificial intelligence, and mad artificial intelligence, no less, from a company called Infinity Rooms. So there's a whole story behind that, but I won't bore you with that for the moment. We'll save that for another time. So increasingly, I have new ways to raise capital, investments and funds basically for whatever bank, whatever business I actually want to scale up and kick off. Now, when we have a look at payment trends around the world, Generation Z, 71% of people have credit cards. However, when we have a look at Gen X, 45% of Gen X actually have credit cards, and increasingly they kind of favor buy now, pay later. So we see these intergenerational shifts when we talk about payments. However, when we actually have a look at the latest patents that are coming through in the mobile banking world, this is kind of how they break down. So about 50% of patents at the moment basically are for mobile banking, crypto, blockchain, and NFC. However, then about 30% are of patents that we see globally, especially led by the Chinese, obviously. Uh, those patents are cross-border, security-related payments, so think banking security, so biometrics, that kind of stuff, and wallets. And then the rest is peer-to-peer payments, point of sale, and bank transfer patents. So when we actually have a look at the direction of travel for financial services as well as payments, patents are always a good indicator of what companies are thinking about, what they're investigating, and where they are tentatively investing. However, as the world starts getting more complex, as we start moving from the American hegemony basically to a bipolar or multipolar world, we're actually starting to see an economic decoupling of the world. That's the Western view. Now, if you're anywhere else in the world, if you're in the global south, or if you're in the global northeast or northeast, uh, we could say that the world is not decoupling. We could say that it is regrouping. So America is increasingly famous for using financial sanctions against countries and businesses that it just doesn't get along with, doesn't like, and so on and so forth. Now, the US as the global reserve currency means basically that they just have the financial clout to be able to sanction a country and almost cut that country's supply of funding, money, and so on and so forth off. So increasingly, we're seeing new ACH networks. We're seeing the BRICS bridge. So when we have a look at BRICS Plus is now starting to create a rival to the SWIFT network so they can all trade with one another. And if America sanctions them and kicks them off the SWIFT network, then they just don't care. We've seen BRICS Pay being vaulted basically as a replacement to the US dollar. However, there's lots of debates about that. We have SIPs, we've got RTGS, we've got RTC, we've got real-time payments in Brazil. So real-time payments are doing very nicely in Brazil. That's a completely different payment rail. We see SEPA and SWIFT, obviously, and then in India we see UPI. And when we have a look at UPI, for example, as a payments rail and as a payment system, it's very, very successful. So increasingly, we're seeing different countries around the world embracing what we call financial sovereignty. So this is where they are creating new rails, new economic systems. This is where they are prioritizing different currencies to try to ensure that in the event that they piss off America, they are not going to be as hurt by sanctions as they otherwise would be. So increasingly, financial sovereignty is a tool that blunts American economic tour de force. Now, increasingly, again, as basically we look into the future, we see payments embedded into everything. So payments embedded into what we call vertical apps. Now, this is incredibly powerful. So, for example, if you have a gym, you know, that gym might be using gym booking software. Now, traditionally, you'd go and book your yoga classes or your squash courts or whatever it is you wanted to do on the app. However, as these apps include banking or payments basically within the apps, all of a sudden now that little business can start selling you things on the app. So that's good. And organizations like Stripe, for example, are making billions of dollars now basically from those payments. And just by simply allowing organizations or enabling organizations to embed payments into apps in new and convenient ways. However, consider this. As again, we start using generative artificial intelligence to build new apps. For example, we've seen Google. Google recently came out and said that 25% of all of the new Google code that's been written has been written by artificial intelligence, not humans. As we start using artificial intelligence to write new apps, at what point does OpenAI, Anthropic, or Google start saying, why don't you embed our payment system into your app, into your gym app, whatever it happens to be? So this is where I see quite a lot of disintermediation coming in the payments and the mobile financial services world, especially when we think about uh, um, open data platforms. So with this particular um, slide, I think that there could be a huge amount of opportunity, but also a huge amount of disruption coming. Then we have DAN. So DAN stands for Deferred Authorization Network. So I've talked about artificial intelligences that make money. I've talked about artificial intelligences that pump money and cryptocurrencies to new highs. DAN, which is a coin-based technology, is where you give, as an individual, you give artificial intelligence the authorization to spend your money on your behalf. But it goes further. DAN is also a way for artificial intelligences to spend money with each other on different goods and services. And we've seen this actually prototyped, and we've seen experiments run, and they've been successful. So this is where, for example, an artificial intelligence might want to buy a bit of extra cloud computing power so that it can do something. Now, under the old system, it would have to have access basically to your wallets and everything else. But this is where now you can give artificial intelligence its own crypto wallet, and it can now start spending the money from that wallet in whatever way it wants. So it now starts spending money from its crypto wallet, gives some money to another artificial intelligence, that then gives it some computing power back. So now that AI has the ability to make money, pump money, and spend money, this is where increasingly we can start talking about the role of artificial intelligence in manipulating the behaviors of the global economy, and even one day managing the entire global economy as well. Then we've got wrapped crypto. So as we start talking about payments, this is where wrapped crypto simply lets us spend money between different chains much easier than we normally could. So these particular protocols basically are incredibly powerful. And then we've got biometric payments. Now, biometric payments, I mean, realistically, using machine vision and artificial intelligence, you can authenticate anyone. I could walk into a shop with my favorite piece of wood, show that to the camera, and it would scan the piece of wood, and it will say, well, that's Matt's wood because it's unique. You know, we know it's unique for a whole variety of different reasons. Yes, Matt, you can buy your can of Coke. However, when we have a look at biometrics, on the one hand, yes, we can pay with face. Yes, we can pay with palm now, basically with Visa, where I just show you my hand like that. And you don't have to take your smartphone out with you. You don't have to take your credit cards or debit cards out with you. You just literally show a system your hand and you pay. So when we have a look at the use of biometrics, increasingly you can actually use your heart rhythm to pay and all sorts of things. And if we have a look at, say, palm payments, it's actually two-factor authentication because it will take your palm print, but it will also read the blood vessels that are in your hand. So increasingly, when we talk about the future of payments in terms of, how we pay, what we pay with, it's literally anything. It's just not restricted to biometrics. And then finally, a little while ago, so about a year ago, researchers in America did experiments and found that everyone's individual brain waves are absolutely unique. Your brain waves are a unclonable biometric fingerprint. So as we start having a look at the development of new quantum sensors, so for example, the University of Surrey has developed a quantum sensor that can read your mind from across the room, can read your alpha waves and beta waves and so on and so forth. Put quite simply, in the future, there is absolutely no reason why you wouldn't be able to just pay with a thought. And when we talk about paying with a thought, 3 years ago, Microsoft put in a patent with the USPTO in the United States that enabled them to own making cryptocurrency with your mind. So I'm going to leave it there. Thank you very much for listening. So when we have a look at the future of payments, money, and when we have a look at the future of banking, whether that's banks, fintechs, or decentralized finance, I encourage you to do these 4 things. So unlearn, because I've shown you how a fridge can disrupt a bank like HSBC or Lloyds or whichever your favorite bank is. Experiment, because technology combined with human ingenuity lets us do, frankly, new and crazy things that make the old status quo look ridiculously out of date. Explore, because again, I've shown you lots of different viewpoints. For example, artificial intelligence making money, spending money, and pumping money. And then expand your horizons, because the vast majority of organizations will typically look at what other companies are doing in their space. So you typically stay in your swim lane. Get out of your swim lane. So, for example, as we saw with Revolut, as we saw with Inter, they could have just stayed as regular fintechs, regular banks. However, they expanded their horizons, they looked over the fence, saw that there was some green grass, and decided that they wanted to go and play on that side of the fence as well. And because they are digital natives, they can do that easier and faster than ever before. But fundamentally, as we have a look at the act of digitization, I also argue that we are moving into the post-digital age, because as we saw with Bank 6, for example, increasingly we are moving from digitizing the bank to embedding smart, sophisticated, autonomous artificial intelligences basically within, shall we say, the core banking infrastructure, which then means that increasingly you are building a brain within your bank. So the vast majority of tier 1 and tier 2 banks globally will now start finding that from here on in, they are no longer doing digital transformations. They are doing intelligence transformations. And that's what I hope I've helped you achieve today. So thank you very much for watching. Let me know what you think in the comments below, and have a great day. Take care and goodbye.